Hi again and welcome to a new episode. This is a bit of a special one. After analyzing Shift4 for our TDI members, I felt there was more to discuss with Niklas, the writer behind Heavy Moat Investments on Substack. Niklas, for how long have you been a shareholder of Shift4 now?
I haven't been a shareholder for too long. I think it was late 2025. But for the short amount of time I have been a holder, I've lost a considerable amount of money. So it has been moving fast.
Yeah. And that's true, but the underlying business has performed remarkably well. Why has the stock declined then? And could this be an opportunity? Let's begin.
As a not so fun fact, Shift4 has been my biggest loser. I think not percentage-wise, but in real euro terms, has been my biggest loser so far in my investment journey. I think there are multiple reasons. So, of course, the peak was when they announced the acquisition of Global Blue. The market hates it. I think it's certainly not a great deal they made if we look at the recent performance of the business. So definitely justified to have some sort of sell-off based on the Global Blue deal, but I think it's overdone. Then we also have the problem with financing. They have a lot of debt and they are aggressively continuing to invest, while Wall Street probably would prefer if they would instead service their debt and focus on deleveraging. I think that's probably one of the biggest catalysts, as we have seen in the last week actually, for the stock. They need to get back to an investment grade balance sheet, because some people, I don't know how they get that idea, but some people are actually questioning their if they can stay away from bankruptcy, which I don't understand. They don't really have a problem with liquidity, and they shouldn't default on the debt. But some people actually have made that point without substance behind it. But it adds to the whole bear case that's going around of a business with a questionable moat, loaded up with debt, making expensive acquisitions, and other players eating their lunch. That's basically the bear case, and there are a lot of shorts around. I think before the recent rally, they had like 38% of short interest or something crazy like that. So
the argument of Shift4 going bankrupt is highly unlikely in my opinion as well, because they are net profit, they are profitable, they are free cash flow generative. The only problem they have is of course their debt, because they are quite leveraged. They have a net debt EBITDA of around 3, and of course they have to pay the interest and the loans eventually back. I think that's doable, and I think so are you, Niklas?
So actually last week earlier this week, they have announced a new financing. They have I think $750 million term loan until 2032, which they use to refinance their debt coming soon. I think it was 2028. So the whole maturities are pushed out further. So they only need to care about the interest payments, and there aren't like huge maturity walls they have to service. No. So that probably was the reason why shares ran up a bit. Shorts covering probably because they were betting on liquidity issues. And also what we need to remember for this year is that they have done a lot of one-time situations, like resolving the agreement with founder Jarek Isaacman. I think it's called TRA agreement liability. So that was a one-time cash outflow. So this quarter and the next quarter, Q2 are probably like, if we just look at the numbers, the ugliest we will get.
Yeah. Okay. So Niklas, Shift4 grows both organically and through acquisitions. do you have any idea how much of the company's growth comes from organic growth and what part of the growth comes from acquisitions?
Yeah, that's one of the, let's say, annoying parts about Shift4 is that even though they have improved it, their investor relations are still a little wonky. It's very hard to differentiate between like what is actually organic, what is acquired growth, and then also trying to understand what they are saying. So the way Shift4 is operating is that they are aggressively acquiring businesses. Oftentimes they acquire merchant acquirers with very large payment volumes, where they then rip out parts, make the business more lean. They oftentimes cut out subscription fees from software products and fully focus on the payment volume. They try to push that. They are using aggressive terms often, and they are also very aggressively trying to get customers to adopt their systems. In order to do that, they subsidize their hardware. So they basically, in many cases, give the hardware for free under the terms that they are doing the payment volume through Shift4. So that has been very successful because a lot of these acquirers are underpricing their product, and so Shift4 has been able to get a lot of upside there. But the problem is, how do you really differentiate then between, is it still acquired growth or is it organic growth if 1 year after acquiring the merchant, it's upselling the business from there? So it's really, really tough to get a number there. For last year, they said it was 19% organic growth. Now I think they guide this year for 11%. Maybe that's true for now, but what would happen if they stop acquiring? They probably would still grow with at least a mid-single digits, I would say. Maybe they can push it to high single digits to close to 10%. So yeah, in the past, they've always grown above 10%, but yeah, competition is there. There's a lot of competition in general in payments, and
let's talk about that in a few minutes, because there is a lot of competition, definitely. About their aggressive accounting, there's just so much noise as well in their adjusted numbers. Like the adjusted EBITDA number contains, for instance, acquisition and integration costs. In my opinion, if they are structural for Shift4, they are actually structural costs. Then you have to not add them back to the numbers. And also the stock-based compensation. I just hate when companies put that back in the numbers. So about competition, who do you believe their top 2 competitors are?
I would say the biggest one is Toast. Especially in restaurants, they are the leader there, and Shift4 is the second place. But there have also been some attempts of Toast going into hospitality as well, because there is an overlap. Because if you can service a restaurant, you can service the restaurant in a hotel, for example. If Toast, for example, would attempt to really push into that vertical, that could get a little tricky. But then again, it's a different business, and they would have to adopt a lot of their business first.
We will talk about these segments in a minute, because Shift4 operates in 3 different segments. You have unified commerce, restaurants, and hospitality. You also have tax-free shopping now as well, because of their Global Blue acquisition. But let's start off with unified commerce. This basically means, besides in-store payment processing, also offering online payment services to their merchants. So a quick question, is this similar to the offering of the likes of Global Payments, Stripe and Adyen? Do they compete?
So the way I understand it, it's standard merchant acquiring, and
I believe this is mostly like on the SMB segment, so focused on restaurants, hotels, but also sport venues. Processing the payment of the online ticket, for instance. Is that how we can view this volume?
The way I understand it, I would view it that way. Again, they talk a lot but it's not really, you don't really understand after they talk for a while. That's one of the issues I have with management. And it's pretty evident if you listen to the new CEO talk. It's a lot of flowery words, which is unfortunate. So they could use simpler language.
Because it is quite a significant part of their payment volumes. Because when you look at their Investor Day presentation 2025, it is like at least 1/3 of their processed volume. So it's quite significant. But a good solid explanation lacks there, in our opinion.
Yeah.
Okay, so they have a net revenue retention rate, basically volume based of 103% in this pillar, in this segment. That means without adding any new customers, existing customers grow payment volume by about 3% a year, and that is because they upsell and because of organic growth. And when we compare that to Adyen and Stripe, that's well below the roughly 15% annual growth they perform. Does this mean that Shift4 is losing ground in this space? What are your thoughts on that?
Yeah, the question is with net revenue retention, it's always also a function of churn. In restaurants, they definitely have a higher churn because restaurants often go bust. In the unified commerce segment, it's tough to say because when they acquire these merchants, they are trying to push their contracts, and oftentimes it works, but they can't convert all of them. So they often also stop doing unprofitable business. So you have a lot of these dynamics which aren't really that well explained. So I would say the difference probably isn't as high because you have these instances where they are giving up business which wasn't profitable. And they also have a strategy which is called, I think it's called rip out the parts. Basically what they do is they look at the business they acquired, they look at what they already have, and they delete the parts, it's called. And then they stop doing the business which is inferior. So if they, for example, have a gift card option in their existing business, and then they acquire the business which has a very good gifting feature, they will then stop using their own feature, but instead use the acquired one. So that adds a lot of noise as well, because they will acquire a business and then stop doing some of what they did. So that probably drives the net revenue retention down as well. But to the initial question, I still think that they are probably not really a share gainer. Maybe they have roughly a flat share, but I don't see them as an aggressive share taker like Adyen and Stripe in the same way.
Mm-hmm. Yeah, we must not forget that the unified commerce, there are just so high switching costs because it's so sticky. If you have your online payments infrastructure flow through one provider and your in-store, your terminal process volume as well, it's just, you have to replace so much of your existing business if you want to change their provider. So the stickiness is extremely strong as well for unified commerce of Shift4 as well as for Adyen and for Stripe. So let's now move on to the second segment, that is restaurants. This is their bread and butter, right? This is a significant part of Shift4's business. So what do they exactly offer restaurants?
Yeah, on restaurants, they have a very diverse business offering. Basically, they attempt in all of their businesses to find complex customers and cater to all their needs. And that's basically how they see their competitive advantage. So if a customer in a restaurant wants to adopt Shift4, then they don't just want the payment volume, they also want software on that for their backend. They want an option to dine the tables, and they want the whole infrastructure behind it. So it's not just a little POS system which you exclusively use to do the payment. You get a lot of software behind that.
Yeah, it's like POS reservations, kitchen display systems, and of course payment processing all in one system, right?
Yeah.
So why would a restaurant then choose Shift4 over a competitor like Toast or Square or Clover or Lightspeed? You have so many different players. Why would they specifically choose Shift4?
Yeah, I think we need to differentiate between niche players and between universal players. If we look at a Square, a Clover, or Lightspeed, Lightspeed, I'm not sure, but at least Square and Clover are very diversified businesses which offer POS for very big range of customers. So they don't have the same focus on exactly the restaurant vertical. They cater to all different customers. Also on Square in particular, I think they cater to very small businesses. Shift4 is more in the middle, I would say. They look for chains, and then if we look to Toast, which is the other big player in the niche business, they have the better business, the better software, the better package, I would say. I think I read somewhere that Shift4 has around 400 features in their software, and Toast has around 500 or so. So most of business needs can be done with Shift4. If a restaurant wants a few novelty features, then they will go to Toast. What Shift4 has going for them is that they have a lower total cost of ownership. So they look to set up these businesses with cheap hardware, and especially in restaurants, I think that's important. Because restaurants are notoriously hard businesses and a lot of them fail. So if you have a business with a, let's say, 50% likelihood that you will exist in 3 years out, you probably don't want to invest like 15K on a POS system. You will happily take the pretty good solution of Shift4 compared to the perfect solution from Toast, if you can get it for basically free, and then get charged by payment fees.
Mm-hmm. Okay, so you basically say Toast is the leading provider in this space with the most advanced offering, and then Square, Clover, and also Lightspeed. Yeah, they have good solutions, but they aren't as advanced as Toast, and Shift4 is basically in the middle, as well with pricing, as well as the quality of their product. Do I understand that correctly?
Yeah. So okay. At least if we compare Toast to Shift4 in particular, and the other ones, as I said, are more general.
Mm-hmm. Yeah, Toast is also like so focused on restaurants and cafes and hospitality. When you compare that to Square, with their they are of course part of Block, the listed company Block. Clover is part of Fiserv, and Lightspeed. They also have a retail offering, which is a key focus of them. But Shift4 as well is focused on unified commerce and hotels and a bit of retail as well. So you can't say like Shift4 is solely focused, such as Toast, right?
Yeah, but we can definitely say that Shift4's roots are in the restaurant business.
Yeah.
So when they came public in 2021, I think it was, they only had the restaurant business actually, I think. Mm-hmm. And then they acquired a business to get their stadium business going, and then they also did the Global Blue acquisition. So they have diversified a lot, but their roots are in restaurants.
Yeah, it's a strong focus, but not their sole focus as with Toast. But definitely agree. In the US, they have an offering called SkyTab POS. That is they're primarily focused. And in Europe, they did an acquisition of Vectron, that is a POS provider. Why not just push the SkyTab POS solution to Europe? Because they've already developed it. Of course, it's not tailored to the European needs, but with small adjustments, it can be. I know Vectron quite well. It is a good offering, but quite expensive and not cloud-based, I believe. Why just not tailor the SkyTab POS solution for the European needs?
Mm-hmm. So I actually have seen the Vectron system as well. In German bakeries, it's pretty common actually. And I have also seen Vectron labeled ones, but also already have seen some with the Shift4 labeling. So what I think they are doing is that they are not forcing them to upgrade, because a small bakery they don't want to invest a lot of money into a new POS. They want to use what they already have, and it's working. It does what they need. They are already giving the payment volume to Shift4, so why bother? It's working. But if somebody wants to upgrade, they will get a Shift4 branded offering. So I think that's basically the way they are looking to roll it up, and especially for these smaller merchants, a bakery shop is probably not gonna do like many millions in volume. So
no, more like 10K, 20K a month or something like that. Agree. Is it so that Shift4 processes the payments then for Vectron? I mean, what I see here in the Netherlands is that the Vectron devices are the payments are processed for, with example, Worldline or CCV, that kind of players. Could you give a bit of explanation why, if that's the case in Germany, are the payments processed with Shift4 or not? Do you know?
I haven't checked that yet. I would say it's probably depending on the contract. Not sure if they can if there's an already existing contract, they can overrule that with changing it. But the new contracts are most likely going to be focused on the payment volume, because that's what they always do. They look at the business they acquire, look if it already has a fit, if they need to change it, and if it doesn't need to be changed, they will just put their payment rails on it and take the take rate.
Yeah, agree. And for clarity, just like Adyen, Stripe, Worldline, WorldPay, and all those players, Shift4 is an PSP as well. So they have built their own payment systems, and they make a good margin on that. But let's go.
Margin, I think, is like 60 basis points.
Okay, on average, is their take rate is like 60 BPS.
Yeah, through the business.
Yeah. Okay, interesting. Let's go to the second segment, and that is hospitality. So they are serving, besides restaurants, hotels, stadiums, and other entertainment venues. And from everything I've read, this seems to be the business with the strongest moat, because switching is so incredibly difficult. And this segment, we can also see that in the numbers, also has 115% volume-based net revenue retention rate. So could you explain what makes this business so strong and sticky, Niklas?
Yeah, that's basically the business I bought Shift4 for. Because it is the best business in my opinion. They have a monopoly almost with around 80% in the US, and they have recently also announced some expansion into, I think, Canada and also other countries. So they are expanding internationally as well. Actually, this business was acquired, and they then managed to grow very rapidly, making it the basically industry standard in the US. So what they do is they serve very large venues. Basically, all of the stadiums for the World Cup will be served by Shift4. So that's a very interesting dynamic right now for 2026. And here again, it's their focus on very complex customers, and doesn't get a lot more complex than having a large stadium with like 70,000 people in there that need payment acquiring. And then again, there are a lot of different things that you can pay for. You can pay for the ticketing, for example. You then have the merch shop. You have like a drink shop. You have some food vendors and all that kind of stuff. So the more complex some systems get, like a large stadiums or a hotel, the company doesn't want to have like a dozen different providers. They want one solution, one person to talk to if something breaks, and that's what makes this a lot more sticky than a like, let's say, pop-up restaurant shop in a high street that gets changed every few years.
Yeah, definitely. Switching is incredibly difficult. Do you know if they've raised prices significantly in the last few years, or how that evolved?
I'm not sure if they've talked about that, to be fair.
Yeah. if we look at their net revenue retention, then we can say, the chances are quite high they did that, or they attracted a lot of new customers, because a 115% NRR is just best in class.
Yeah.
Who would you consider their biggest competitor in the hospitality segment?
Yeah, I think there aren't too many strong competitors there yet. I think there was some small news that Toast is actually trying to compete there, at least in the hotel space, I think. Because it's not far-fetched if Toast already does restaurant and POS to then go into a hotel and do the restaurant there, for example. So that could be some way where they expand, but it's not that big of a deal yet, at least. I haven't come across a too strong competitor there.
And they are not really, they are still not really focused on expanding their hospitality segment, their business there to Europe or Asia, right? It's primarily in the North America.
Yeah, so far it's primarily there, but they have large customers. So if they have a large hotel chain in the US, it's probably easier to then go into another country and do processing there for them. So they have definitely the opportunity to expand that way also. Yeah. But there have been at least some stadium wins in Canada, if I recall correctly.
Yeah, amazing. Yeah. They are not servicing the Marriotts and the Hiltons of this world, right?
I think it's smaller ones.
Just smaller chains, I believe.
Yeah. But also what's pretty interesting is I saw that American stadiums are very different to stadiums in let's say Germany. There are pools in some VIP areas, for example, in a stadium. So American stadiums probably have the biggest opportunity, given what kind of stuff they put in there. That's probably something Europeans would see as not necessary.
No. Super interesting though, but nice. Hey, finally, following the acquisition of Global Blue in 2025, Shift4 also entered the tax-free shopping market. We've already briefly discussed your thoughts about the acquisition, but what is the rationale behind it? Is it mainly about cross-selling? Because I believe, Global Blue services, for instance, Hermes and like dozens of other super high luxury brands. If they can process those payments as well and be their POS, it will be super beneficial. But what is the rationale behind it?
Yeah, I think management thought that the standalone business was already an interesting deal, and that they could justify the purchase price just with that business alone. And then on top, they have the optionality of cross-selling their all of the payment volume they could potentially get through the merchants that are already using Global Blue. The question is if that will turn out true. So far, what they have been guiding for Global Blue has really been impressive, and probably that's a big reason why the stock is down so much. If I remember correctly, in the initial pitch after they announced the acquisition, they aimed for a double-digit organic growth rate for Global Blue, and now for this year they are targeting mid-single digits. So, yeah, it's kind of a tough market, I would say. It's a new vertical. Maybe they have just overestimated how much they can cross-sell. Maybe it's coming. I don't know. It hasn't been too transparent. And then also the Global Blue assets get some new seasonality. There are some changes in cash flows because of it. I think the first half is consuming cash and the second half is very cash flowing. Probably because a lot of the tourists are traveling in the summer. So yeah, it has just added a lot of complexity for not really that great of a payoff so far. So I'm not really a huge fan of the deal. took a lot of debt to get it through, and yeah, it just makes the business so much more complex, and it also, in my opinion, removes the option of a buyout, because now with another vertical and so much more complexity, you will struggle a lot more if you eventually would want to sell the business.
Yeah, we should give them some time to show if they have to take off their plan, and let's see if they can meet their first initially target. But so far it doesn't seem to be a great acquisition, and one of the key risks, I believe, is they are getting so complex. Like, it is something that investors worry about. It's something, when you do 10 acquisitions, for instance, they have to manage 10 businesses and 10 cultures, 10 bookkeeping systems, and it's very difficult to keep your initial culture and the right people on board if you do so many acquisitions, I believe.
Yeah, I would say it has been their strength to actually handle that pretty well in the past, because they have always, well, not always, they were a fully organic growing business for the first 15 years. But once they started to get investor money and to start growing inorganically, they have done a lot of deals, and they always have been good at cutting out costs. And I mean, their delete the parts strategy focuses on deleting software that is duplicated, and they also aim to retain good people, because they need to hire them anyway, so might as well keep the people that already know what they're doing. But I think with Global Blue, they doubled their employee count, and that's definitely a lot harder than a small bolt-on for 80 million or something like that.
Yeah, it was definitely not a bolt-on. It was just so large, and given the science and the knowledge that most large acquisitions actually fail, this is just super risky in my belief. So I'm a bit of a skeptic in this sense, but let's see where this ends up in a few years. And whose idea do you think this was? Was it Jared Isaacman's idea, who was the former CEO, and now Taylor Lauber is the CEO? Do you think they made the decision together, or was it largely Isaacman? Well, any thoughts on this?
Yeah, what we need to keep in mind is that Jared is still the largest shareholder. He has around, I think, 26% of the company. So he definitely is very much aware of what's happening, and is also having his voice heard. Actually, there was an issue for many investors, because Shift4 was a dual class share structure because of their the way they handled it before. All of this collapsed now that Jared Isaacman moved to head of NASA. In order to do that, he had to forego his TRA liability, which is a tax receivable agreement. Basically, through the time they were private and making losses, they had developed a tax shield. And when they went public, there was an agreement that part of that tax shield will be paid out to the former owners, which was Jared in that case. That was also tied, I think, to the different share classes, and all of that collapsed. So that declined the complexity of the business in two ways. First, the share classes got collapsed to one class, and also the liability is gone. But what I wanted to say is that Jared is on the board. He is important. He definitely was part of that deal. Tyler has been there for a while, and I don't think it was his decision to push it out and to have a monument for himself or something like that. I think it was definitely a decision between the whole team.
Mm-hmm. Yeah, I hope so, because Taylor Lauber is now the one who has to manage the business and also get a lot of questions from investors and people like us. Yeah, and talking about our prior subject, during the earnings calls, analysts almost seems frustrated. You can almost hear them thinking, what kind of company are you actually trying to build with this Global Blue acquisition? And Lauber keeps explaining that they are building a platform to power the experience economy. Given the market's reaction, investors and analysts don't seem fully convinced or happy with that explanation. What are your thoughts on this?
Yeah, I hate listening to the earnings calls because it's always so much talking and so little substance behind it. So it has been very rough to transition here. And also a few months ago, they released their new compensation structure, the new package for the management team. And I actually messaged investor relations for a question I had about it. And Tyler answered it like super fast, actually. But the way he answered, I was not much smarter afterwards because it was a lot of words and little substance explaining it. So yeah, basically what they did is they used a free cash flow per share target for the compensation package.
Adjusted or not, Niklas?
I think it's adjusted, but what makes it really, really weird is that it's not a full year target. It's, I think, Q3 28 target. So if you play devil's advocate, and I did that also, I wrote that in the email, you could basically pull forward a lot of working capital payments and stop investing for that quarter just to juice up the free cash flow in that quarter alone. So yeah, I don't know. It sounds really weird to put a quarterly free cash flow target for a long-term strategy.
Yeah.
It makes a lot of sense to focus on free cash flow per share because they have done a lot of buybacks lately as the share price declined. But also here, they have not really communicated well because one quarter they were still talking about their long-term target of getting to 1 billion in free cash flow. And then suddenly they start talking only about free cash flow per share because they have spent a lot of money on buybacks. I think buybacks make a lot of sense, but the way they communicate really is almost infuriating as an investor trying to grasp what the hell they are trying to say.
Just overall, what are your thoughts on Taylor Lauber and Christopher Cruz as CEO and CFO? Because what I have heard, they are really acquisitions, mergers and acquisitions kind of guys who have worked at banks before and just super focused on M&A. If they are really good in that, of course, maybe that is value adding. But I'm just not quite fond of people who do a bit of empire building because of large acquisitions. What are your thoughts on these guys?
Yeah, so on Taylor specifically, I think he was one of the earlier employees back when the business was really small. And then he went for other gigs, did other stuff and came back. So he knows what he's doing. But yeah, the focus on M&A is ingrained in the business. So will be really interesting to see how they handle it from here. After they have done a lot of deals. They said they will continue to do small bolt-ons if they make sense, if they can get a lot of payment volume for cheap and then put their strategy onto it. But yeah, it's tough. What's really good is that they are flexible and that they are focused on the per share growth of the business, as we see in the buyback. But yeah, the jury is still out to see if they can live up to the promises.
Yeah, and now Jared Isaacman has stepped away. Is he still heavily involved into the business as he's still one of the largest shareholders? Or do you think, he just is fully focused on running NASA?
Yeah, I mean, he has been buying actively in the open market, so he's definitely increasing his holding from the 25% or so he already has. He probably is not running the day-to-day business anymore, but for large strategic decisions, he will definitely still be, at least consulted.
Yeah, let's finish off with the valuation. This is how I valued Shift4, so I'm keen to hear your thoughts about this as well. So management is targeting roughly 30% revenue growth over the coming years with the Global Blue acquisition as well. Growth will probably slow down after that. Also, this is super dependent on future acquisitions. And given the company's leverage, it seems unlikely they can pursue any major acquisitions, or they must dilute shareholders more. So assuming around 20% annual growth after that in the next decade, a 10% net margin and a 15 times exit multiple, 2% annual dilution from acquisitions, I estimate investors could earn around a 17% annualized return on Shift4 currently. How do you think about that valuation, Niklas, and how did you value Shift4?
Yeah, I have two different models, and I get between a 16% and a 20% IRR. What I model differently is that I model a reduction in shares outstanding and not a dilution, because they probably will have a 2% dilution, but they are actively buying back shares. But if we assume a lot of buybacks, growth is probably a little lower than 20%. They also have a lot of business already they acquired, and they have a lot of things to cross-sell. So that's really the story you need to believe in, that they can cross-sell, and they have said that without acquiring another business, they should be set to do like a 15% growth rate. So that's at least what they said in their investor day when they acquired Global Blue. If it turns out to be true is to be seen. But I think where they're trading now, and also with margins not really where they could be, they estimate that that incremental, or like they already say that incremental margins are a lot higher, and eventually all of the integration costs and so on from the Global Blue deal will go through, and that should lift up the cash conversion as well. So what I question more is if I was initially wrong on the business, because I bought shares at twice current price. I think the most expensive shares I bought were like €90 and $90. So yeah, if I look back, I don't really see large mistakes. The biggest mistake for me personally probably was averaging down too aggressively, because I have built a like over 10% position when Shift4 was trading at $75, I think. So
you were just super convinced when you bought the stock. If I hear that correctly, and has your conviction comes down since then?
Yeah, since I bought, there was a lot of things that did not feel too good, especially the communication and them switching targets a lot. And yeah, initially early on, there was a lot of positive things which are still there. But I think I did not see the negative things too much. And I also was too convinced on just the growth story without acknowledging too much the debt they have. And there is a lot of execution risk. I underwrote a lot of growth. It's probably not the best idea to size up a position that much where you have a range of 15 to 30% revenue growth. So yeah, that's probably the biggest takeaway is to be more conservative on high growth businesses. And yeah, also what I have kept in mind is that screeners had for a while wrong multiples, because you already had some of the, or like we already had the costs of the business of the Global Blue acquisition. You already had the costs and the decline in cash there, but you did not have the revenue. So multiples on, for example, Koifin or Fiscal AI were off, which made it harder to analyze as well. And just in general, looking back, this is not the kind of business I should make like 10 to 15% cost weight, just because of the complexity and the amount of change. All of the moving parts. That's a good lesson. Yeah, definitely. All of the moving parts going on there, and also the competition in payments is strong. So it's always hard, and the sentiment is bad. So it's really one of the stories where you should probably try to average in over a longer time. And I think over the span of like 2 months, I made it a 10% position, and that was pretty quickly.
If we digest that down to just 2 learning points, what I heard from you, Niklas, is that you have been too aggressively with scaling down, with buying when the stock went down, and secondly, your assumptions were a bit too aggressive. So I think we can all learn from that. So thank you for sharing. What I hope for shareholders is that they just not do any acquisitions in the coming quarters or years. Just focus on implementing the acquired businesses and scaling, because their business is super scalable. So margins should increase in the coming years. And that's what I hope for you and other shareholders as well.
Yeah, I would say they can continue to do small bolt-ons. There's not much harm done there, because those are actually pretty profitable. Because they get a lot of volume, and they historically have been able to upsell those a lot and make them a lot more profitable. But if I see another deal close toward global blue wars, I will probably run for the hills, I would say.
That's honest. Niklas, thank you for joining us today. And if listeners want to follow your work, where can they find you?
Yeah, the best place to follow me is on Substack at Heavy Moat Investment.
Perfect. So if you would like to read our full 30-page write-up on Shift4, consider becoming a TDI member. Niklas, thank you for your time today. Thank you for sharing your knowledge. You have definitely you have contributed a lot, so thank you for that. And hope to see you another time. Any last words from you?
Well, as always, has been fun making a podcast with you guys. So I'll probably be back sometime in the future.
Perfect. Thank you, Niklas. Thank you, listeners. Bye.